Welcome to the Dividend Talk podcast, episode 157. Texas Instruments, a business breakdown, and our thoughts about the stock. Hey everyone, welcome to the Dividend Talk podcast, a show that empowers ordinary investors to achieve financial freedom through dividend growth investing. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Hey, European DJ. How are you, my friend?
I'm really excited because, earnings season is so much going on now. And we are recording this on a Tuesday evening. And if you just see how many earnings are coming in, Visa, Microsoft, Unilever, 3M, Verizon. I mean, for me, this is what you live for as a passionate investor, right? And I know we shouldn't be focused on the short term. And I also don't look at it really at those reports at the short term. By the way, I can only do 2 or 3 quarterly reports on a day like that, right? Here, because I don't want to spend. I want to do it meaningful, so I typically pile up those reports for later when I look into the stock again. But what's for me really nice to see is the long-term trends, and specifically if you compare stocks from similar industries, like what's really happening there. Yeah, and it forms your view a little bit more about the industry, and that's what I really like about quarterly earnings, because in itself it doesn't really matter to us as dividend growth investors. Maybe only we can spot sometimes when the stock crashes that we have this conviction because of knowing the everything, and there's the industry headwind or something like that, and then you can buy easier. But for me, it's more like the popcorn, the fun that I'm getting out of this.
Yeah, and sometimes there's clues in the quarterly ones that you don't get, or that would be delayed if you're waiting for the annual report. And I'm thinking back to maybe this time last year, even the quarter before, where every single report was mentioning supply chain issues and inflation, but we were not seeing that as consumers. We did not see it, so it was hard to visualize it. I won't give too much away, but now we're seeing something opposite to that. So, quarterly earnings can give you early indicators of what's coming down the road, which is quite fun.
But you also need to go beyond the headlines, right? Because, for instance, Philips yesterday, they came with so much smoke and mirror in their earnings report with this new CEO. And then if you then just look really just at the net income statement, they're kind of at a loss, making loss at the moment. But then their adjusted numbers all look good. Yeah, and I think someone made a joke today that 3M even had adjusted sales today.
I think that was Russ. As a adjusted sales.
I mean, all these finance shenanigans and such, adjusted sales, adjusted EBITDA. EBITDA is already like fake earnings, and then they have even adjusted fake earnings. I mean,
fake news. But look, we could have actually done a whole episode on earnings. We usually do this time of year, but there is one we want to focus on before we get into Texas Instruments, and it's a company that I won't say pushed a lot, but in the early days of the podcast, we spoke a lot about Unilever in particular. And it didn't perform that well. We have a new CEO at the helm, Hein Schumacher, a great Formula One name, and it looks like it's still early. It's still early days, but it looks like things are starting to turn around a little bit for this company.
Yeah. So what I saw also when I read the earnings report is in the commentary that he said, like, he's getting to know people now. So he said, I will give an update or more insights in the next quarter. So I think what you're seeing now is still a result of Alan Yoppie. Yeah, and let's be fair to the guy. He was a horrible CEO. Yeah, Yoppie. He came in and didn't effectively do a lot. He wanted to buy this business from, was it Haleon, or how was it called?
Yeah,
For
from
it would have put if he would have bought that, Unilever would have been in serious debt troubles right now with the interest rates, and we would have been talking here about a Heinz ketchup company, Kraft Heinz at the time, right, with a dividend cut on top of it.
yeah,
I mean, that was almost what he did. Yeah, it was that shareholder stepped in and sent him back to his desk. But that was Alan Yopi at the time, and um, what you can say now, at least what I liked, if you go to the investor website and you look up at the deck, so not so much the release itself, but the presentation that they have one nice slide in there which shows that there's kind of in this quarter was actually kind of for the first time in four or five quarters that you see some positivity everywhere again when it comes to
yes,
sales volume, and it also showed a picture like they feel like they're kind of getting off the bottom of their margin, because their margin was not so strong and declined there. They feel like they presented it as if this would be now finally kind of a turning point
yeah.
on the horizon.
Yeah, it seems that way. It seems like we've reached maybe a bottom, but let's throw some numbers behind what we're saying here. So if you're looking at their underlying sales growth, which they call USG, it had a 9.1% increase. That's across all business units. They all perform quite similar. Beauty and well-being up 9%, personal care up 10, nearly 11, home care 8%, nutrition is obviously one of the main ones, 10.4, and ice cream is lagging behind, which is not a surprise given that it's the second quarter. You might see that bump up in the next quarter. And then you look at their revenue. The revenue was up 2.7% to 30.4 billion. And some of their brands are coming back. So Hellman's, the mayonnaise, Lux, Omo, and Red. I don't know this one, but Reoxna. I don't know that brand at all.
Rexona, yeah.
But they're the ones they called out. So it seems like it's a bit of a turning point for these guys.
Yeah, and also their earnings per share is decent again. Yeah, it went only up 4% if you look at their underlying performance, but if you look at GAAP measures, almost 23% here. So what I also like in this case is that they are not only showing non-GAAP numbers when they benefit from it, but also when it's the way around. So that's kind of good for them. So yeah, I'm not surprised by the response in the stock market to Unilever, because it was just a bad series of earnings that they had. So, but you know what? How do I don't know if you can say this in English, but one swallow doesn't make a summer. But it sounds so dirty.
Yeah, we use the word swan. We use the word swan over
one
here.
Swan, so another one swallow.
Yeah.
So,
yeah, but one question we did get from somebody, MH79, and it's a good question. And do you now expect them to raise the dividend in the near future again, possibly this year?
ooh.
I don't.
I think that the CEO is not in a hurry. He doesn't need to with the flat dividend. If I were him and I would be CEO, I would give myself some wiggle room in the cash flow first in the upcoming few quarters, and not be too early with a hike and then being handcuffed with your investments after that.
Yeah, I mean, you hit the nail on the head when you said one swan doesn't make a summer. He's going to know that as well. He's going to know, look, this is just one quarter. I'm only in the door. So if I was in his shoes, I would hold it steady for the next 12 months.
Yeah, and what you often see with CEOs is that they take a kitchen sink quarter, right, when they come in. So maybe next quarter he puts all the trash in the earnings, and then with his strategy says, and now the only way is up. Yeah, he didn't do that here, so maybe he's just really loyal, or maybe just Alan Yopi did most of it and he had no influence yet. But that's also often behavior you see with CEOs, right? That they clean up everything, and then you see it with Shell at the moment. Ben van der Burden, the CEO we appraised a lot. The new CEO comes in and says like, cut the crap with all this clean energy. Let's give some more money back to shareholders, and then let's find every oil well we can find and push it to the max. Yeah. So, yeah.
Yeah, makes sense. If I was the CEO, I'd probably do it in my first quarter. To be honest, I would have put the kitchen sink there. But look, we'll see. Maybe he, as you said, maybe he thinks it's already been there, and the only way is still up. So,
well, it's a large position in my portfolio. Typically, it's hovering around the top 5, and then number 5, I always kept it, and I've been just letting it, doing it like this. But because I've not been really concerned about the dividend cut. Yes, so but I'm because I've studied the history of Unilever, like all the way from the Second World War and before, and they cut in 63 or something like that one time with 1.2%, but for the rest they had periods like 2-3 years in a row where they kept the dividend flat. And it sounds like Unilever has a playbook or something like that. You just keep the dividend flat until you get your act together again, and then you start raising it. So that's why I wasn't, and I am not too concerned about dividend cuts. More like, it's more like when does it pick up again, right? The dividend growth, and then over the decade, do we get proper dividend growth out of it?
Yeah. It's the benefits of European companies. We have to look at them differently than our US counterparts.
True.
But speaking of dividend paying companies or dividend growers, we are talking about one of the most impressive ones that is known to us, which is Texas Instruments today. And I'm quite excited about this one because it's a popular stock, probably known as one of your swan, sleep well at night stocks. So it'd be interesting to dig into these and see what we can find.
While they only have a 19 years dividend growth streak. Yes, so it's not like they are a dividend king or something like that with 50 years.
No, but we'll get into that. 19 years is still a lot, but it's the growth rate behind that, which is impressive. But we'll get into the numbers. We will get into the numbers. But maybe before we start going in, looking at the business, I might go through some of the history and some interesting facts that you may or may not know about the company. The first one is that I did not know is that they were founded in 1930. And they were known as Geophysical Services Incorporated, GSI. So initially, they were a company that was providing services to the petrol industry and not what they're known as today. So it's quite a transformation that they've taken.
A little bit like IBM as an example, right?
Yeah. And it shows that some of the biggest companies in the world can pivot over time.
Well, think about Philips that we just mentioned, right? We knew it from the televisions, and now it's a full-blown pharma medtech company.
Exactly. And I'm pretty sure there's probably investors around the time, say 1954, when they went from petrol to making their first silicon transistor. There's probably investors at that time going, "Whoa, what's going on here? Why are they pivoting into that kind of a world?" So it's definitely it's really interesting to see that. And then now when you're seeing companies pivot, like Shell trying to pivot, as investors, we're on the edge going, is this right? I mean, when you're in the middle of the pivot, it's probably the hardest point as an investor, but it's always fun to look back and see how successful some of these huge companies have been. So I mentioned there the first silicon transistor was made in 1954. That's probably one of the biggest advancements we had in the world at that time. Followed then 4 years later by the invention of the integrated circuit. And I believe that was done by two different engineers separately. But Jack Kirby of Texas Instruments gets the credit for this. I think that invention probably shaped the world as we have it today.
But can you explain a little bit more about that? Because you're an engineer, you understand this stuff, right? But there are many people that are not like IT savvy or engineers. What is a silicon transistor, and what's an integrated circuit, and how do they relate to each other?
Yes, if you look at your integrated circuits, they're in pretty much everything. Think about your mobile phones, think about your radios, think about your chargers, and anything that needs power or amplification. They're in pretty much everything like that. So,
but what is its function?
To have all different types of functions. So, for example, in telecoms, it's probably used to amplify the signal up to your gigahertz. So you're trying to send the signal over many gigahertz, which is high up in the sky. So your integrated circuits are going to amplify the noise. They're going to make that noise in such a way that it can send over that signal. Similarly, with power management, you have transistors. Transistors will just, it's like a switch, basically. It's like a fast switch, like a switch on a wall. It's just a faster version of that, which can be really
and
small.
It sends information.
It sends information, sends power, sends pretty much everything. It's I would call them the brains of all your electronic devices. That's pretty much how I would do that. To get into the details about the transistor, the silicon transistor might be a little bit boring, but essentially all they are is just small fast switches. That's the easiest way to think about them.
Okay.
But they are pretty much everywhere, and the best, well, I suppose the easiest thing to think about is your pocket calculator that Texas Instruments is well known for. So they have transistors. They've also got integrated circuits within them as well. And Texas Instruments, still to this day, I think it was 1960s, they came out with this calculator, and it's now 60, 70 years later, and they are still known as the calculator company.
It is because we grew up with them. Yeah, we're the 30s, 40s, and we still were demanded and required to use a calculator during math and everything at school. Yeah, so I had Casio and Texas Instruments, but our kids are not using it anymore. At least I don't see them using it here. So I don't know. Is your son using it?
They don't. So even when I was growing up, we didn't use calculators in our first 2 levels of school. It's only when we get to 3rd level.
What did you then do?
Your brain.
Yeah. Okay. But in the 3rd level, but you did have to use calculators, right?
In 3rd level, when you start getting to more complex maths, you had to use calculators. But kids, even my kids, they still don't use them
because they are too young for that level, or just because I can imagine they do today just on the phone, or something like that.
Yeah. But even in school, they don't use them. So my oldest is in secondary level, and they don't just use them. So it's not until he hopefully goes on to 3rd level will they start using them.
Okay.
Moving on from the 60s, then the Texas Instruments got involved in aerospace projects and were heavily involved in the moon landing. So they were obviously supplying integrated circuits for the rocket ships, which would be quite crucial, helping them to land on the moon. What some people might not know is we talk about sin stocks, and a lot of people talk about Lockheed Martins, all these that are involved in building weapons. Buying Texas Instruments, you could actually still be enabling that, because they were providing chips for missiles and bombs before the selling this whole defense.
They were even building bombs.
They were actually building bombs. That's crazy. Before they sold that, actually, didn't they? They sold that off to
Raytheon, which is now, I believe, RTX. It's called Raytheon Technology.
Yeah. So that's only as far back as 1997, which doesn't seem like that long ago to me and you. That's crazy to think that they were actually building bombs. And now all the talk, as we know, is artificial intelligence, and these guys have been involved in that since the 80s.
Yeah, that was so surprising to me. So they were already focused on artificial intelligence, and they made AI application software effectively for the gate assignment system for United Airlines. And they described it as a time, and that's so nice, right? An artificial intelligence program that captures the combined experience and knowledge of 6 United operation experts. Really interesting, right? And of course, these were probably relatively simple algorithms compared to what we're seeing today.
But still, the concept of AI, it's still relatively unknown, and it's the buzzword now. Everybody's talking about it. Yeah. But I was born in the 80s, and I could only imagine what people thought back then when they heard artificial intelligence. We're used to growing up with technology. Back then, not so much. They had a small bit of it, like they had TVs and stuff, but not at the level we're at now. So for PI to go around and say were active in the area of artificial intelligence. I would love to hear what people thought back then.
Yeah, well, I think it inspired some classic movies as well, right? In this space, so yeah.
Back to the Future is one I can think of.
Yeah. So tell me, what are they doing today then, right? Because it's a really nice history, and it shows how fundamental they were to where we are today, right? You can't say like if those guys weren't there, it wouldn't have been invented, right?
Yeah.
Some of these are, for instance, with the with the silicon transistor, they were the first commercial. Doesn't mean necessarily that they have done all the science, right? But what are they known for today? Where are they now today?
So they are still involved in the analog integrated circuit. So that is the biggest market by far. I think it's about 77% of their overall business. As I mentioned, these chips are everywhere from cars, electrical circuits, have your amplification, and now they're talking about AI. So these chips are absolutely everywhere. Open up a device, you're going to see an IC chip in there.
Is it fair to say that they provide the more simple chips compared to the high end that NVIDIA does and such?
No, I think they provide both, to be fair. If you look at Texas Instruments within, say, my world, automation world, Texas Instruments is like Siemens. It's quality. That's the brand you want to own. I typically would never even go out and look at someone like NVIDIA. I look at them as something for like graphics in your computers, or if you want to boost the power. But in terms of high end, no, I don't think that would be fair to say. I think Texas Instruments are high end in what they do. It's just a slightly different
application.
Niche. Slightly different niche. But Texas Instruments to me is the symbol of quality. If you're buying a Max 232, for example, you're going to buy it from Texas Instruments. You're not going to buy it from anyone else. And in fact, I don't think I've ever bought an integrated circuit from any other supplier in any time I had to buy one, which is quite something, to be fair. Apart from that, then they're also producing their own embedded processing chips. And if you want to know what they are, think about the brains of your mobile phone. Think about the brains of your PC. So they make those. They'll be highly integrated within your new cars, your Teslas and your Neos and all that. So they are they cover a wide range, and you can see why AI is going to be really important. Not directly from them, but they'll provide the components for the applications that use AI, and I think that's where these guys come in.
Yeah. So for me, it just shows like how strong it is, how strong this company is, and how diversified it is. But at the same time, do you see it? How do you classify this? Because semiconductor is often of cyclical nature, right? When there's a recession, people withhold or postpone their PC buying their PCs and such. So, is also Texas Instruments a cyclical business as such?
I think so. And we might start to see that when we look at the numbers. But it's definitely a cyclical business. I know last year was a crazy year for a lot of different companies, particularly in the semiconductor industry, because we had chip shortages and they were able to have back orders and they were able to sell them.
Yeah.
That's going to start to normalize, and we might start to see the cyclical nature, but certainly they are, I would class, a cyclical company. We don't quite see that in the share price, and we might not see that in, say, the free cash flow growth up until now, maybe. But I think it would be naive to say that these guys are not cyclical because of their quality.
Yeah. And what is it then that you feel like that investors or people interested in Texas Instruments should really know then about investing in this company? What makes, so we have a good business, right? We have a good company, but a good company doesn't make a good stock, and a good stock doesn't make a good company.
Yes.
Yeah. So how should investors look at Texas Instruments as with the knowledge that you have? Maybe a little bit like from the business point of view and the stock point of view, or maybe you addressed already a bit on the business part.
Yeah, I mean, from the business point of view, I think, look, the bull case is obviously they're a leader in that analog space, and I think that's undoubtedly so. I don't know the figures off the top of my head, but they own the majority of that market that they're in.
And the market is still growing, the total addressable market?
Of course, that's still growing. I mean, these products are in everything. They're in well, they're in your like automation cars, your cars, they're all your life cycle products, your niche products like applications in your dishwashers, wash machines, like
Yeah.
anything really, like everything is
And
going.
this is a growth trend because we want to measure more also as citizens, right? Like
Yeah,
whether there's enough food in your fridge is the classical example. So this all, I guess, in all those industries, there's a more need for chips in general because we want to be more connected and have everything connected, right?
exactly. And you want to
Yeah,
do things faster and faster and faster, and you
yeah,
need more transistors, more switches, more circuits. So I think from a business point of view, I think the bull case is there, even though it's
hmm
cyclical. I think they're not going to go out of business anytime soon. They're
yeah,
involved in so much, and it's only getting bigger and bigger. From a stock point of view, I think we'll look at the numbers, but I think you can't ignore some of the key facts that they have in the past. So you look at their annual growth in free cash flow over the last 15 years, it's been about 11%. You mentioned 19 years consecutive dividend increases. That has a 25% CAGR since 2004. You look at the share price reduction. We talk about that a lot on the show. It's 47%. Nearly half of the business, half of the shares have been bought back by this company since 2004. So I think financially, they've been really strong historically as well.
yeah, yeah. And this is what speaks out for me. If we already go, and I really recommend everyone that's listening now, also if you're a new investor, let's say you started a journey in the last 3-4 months, yeah, please go to their investor relations website and just read the first page. Also, take a quarterly earnings report and read it. It is textbook example of how value investors or dividend investors want information to be presented. I don't know in any other better company like this who's so pure into this. There's almost no bullshitting around here. That even today we were going to the quarterly earnings report, and I was thinking like, oh, I need to look up all the TTM numbers and calculate myself because 99 out of 100 companies don't give TTM numbers. They just
Yeah.
say last 3 months or compared to last year or something like that. But no, it's you can easily read left Q3 or Q2, right TTM. It is designed for value investors, this
It
company.
100%, and even the language that they use. You think about Intel. We laugh at Intel, some of the language that they use, laser focused. But if you're a semiconductor company, you would probably try and use buzzwords like AI, IoT,
Yeah,
5G. They very rarely do that. I mean,
yeah.
they brush they brush artificial intelligence, but they don't push it like you think. They just stay away from all the buzzwords. They give you facts is what they give you and numbers, and that's all. And like it's quite refreshing actually.
Yeah, exactly. So, and this also gives me a lot of confidence in such a company because it's also not that they've been doing this for 1-2 years. They're doing this already for decades. Yeah.
Yeah, decades and decades. So
And if you then also from there, let's say, also look then really like, they talk a lot about free cash flow, but they also are really focused on capital allocation, right? So first of all, and they have a nice scorecard as well. So they look at free cash flow generation and then the CapEx, how much they are investing in the business. And I think this is what I want to call out already. So if you now look at the free cash flow numbers, they are bad. They're just simply bad. And I believe in this quarter, it was negative, the free cash flow. And this is not what Texas Instruments is known for. But what Texas Instruments at the moment is doing, they are heavily investing in their future revenue. And they are doing this because, for instance, in 2019 and 2020, they spent less than $1 billion on CapEx. Yeah, in 2021 it was like 2.5 billion. 2022 also still below 3 billion, but the capex will be now in 2023 around 5 billion.
yeah,
So they went from 1 billion to 5 billion almost in 3-4 years, right? And this is something that their free cash flow cannot carry. Yeah. So what is free cash flow? It's operating cash flow minus capex. You have free cash flow. So the free cash flow now dropped also to 3 billion in the trailing 12 months. Well, not too long ago, it was touching 7 billion or something like that. And I believe it's here to stay. Yeah, for the next 3-4 years, because they are expecting these capital in expenditures until the end of 2026, and then it will slowly drop again But what are they investing in? So they're heavily investing in the 300 millimeter chips, if I believe,
Yep.
and these wafers. And this should really give a lot of benefit to their clients, right? That are consuming this. So, and the industry needs it. And what you could argue here, and you see this sometimes with companies that are, because if you look at the history of free cash flow from Texas Instrument, what you will see here is that it went from, in 2011, free cash flow, I'm talking about, from 2.4 billion. It went, let's say, in 2016 to 4 billion. Then in 2018, 6 billion. So it felt like it tripled in those 7-8 years. Yeah. Then it was kind of flattish and such. And now last year, 6 billion. And now it dropped till 3 billion in trailing 12 months. So if you look at it, you could argue also in those years, they have been underinvesting a lot. Yeah, they have been probably just selling whatever they could. The factories were running. Yeah, everyone happy. It was going. And now it is, oh shit, we need to improve. Yeah, there's more demand now. We've seen this boom lately that's everywhere happening in technology. So sometimes you see that companies have underinvested for a while. And Intel is the same. They have underinvested. The only difference between Texas Instrument and Instrument is Intel is that at Intel, with Intel, other companies were eating their lunch, like AMD. Yeah. Texas Instruments didn't have this, so it's still really the best, very competitive, and not easy to capture market share from. But still, if they wouldn't now invest, they would be in trouble. And we see this also with TSMC. All those companies are heavily investing now. Texas Instruments is not different here. So they're investing in chips and the new and upgrades and new plants. And that's why they need so much money now. And with this, they aim to secure much more revenue going forward. So this is really like where the costs go first to get the big rewards and revenue later. And that should really support 10 to 15 years of growth as their estimation effectively. So this is what we need to know now. So, and that also means, again, we are talking here about a company that we shouldn't have too high expectations when it comes to free cash flow generation. Although it is, and that's where I really want to circle back, for this company, it's the top measure of how they evaluate themselves on their performance. Yeah, and because that's where they want to see exponential growth over time.
Yeah, and I'm curious with the capex, because it's quite obvious that they've gone aggressively over this, and it coincides really with the CHIPS Act. And what I don't have a clear picture of is how they're going to benefit from that. But I have a feeling that management think they are going to benefit quite substantially from this, given the aggressive nature that they are attacking this capex. So I get what you're saying. They may have been underinvesting, but I think the time is probably better now with the incentives coming out of the US, China,
yes,
to a certain extent.
definitely,
and Europe as well. I know that was released during the week. Again, I don't know where they fit into this, but there's a trend there, isn't there? Intel and Texas Instruments. I think that's why they've gone so heavy with the
and these are capital intensive industries, right? But you know what it means. There's still net income, and if we look at the net income numbers, it looks very positive. Trailing 12 months, 7.6 billion. Yeah, that's the same level as 2021. So we're really talking about free cash flow here. So what has been also impacting the free cash flow besides the capex, the operating cash flow is also depending on working capital. And what is the issue? And this is already a bridge to the quarterly earnings that we want to touch on as well. They have weakening demand, but what can we see in the inventory numbers is that they are just not able to sell here. They're stocking up at the moment. So while they are paying for this inventory because the production is probably going in full swing, they're not able to sell everything. We don't have the transcripts of the earnings calls yet at this time of the recording. But this is just what I'm reading from the balance sheet and the cash flow statement. Yeah, that they're just not able to sell there. There's probably also some inflation in the cost of goods sold there, but that doesn't explain such a spike in inventory at the moment.
Yeah, and I think it's in the investor relations presentation they have, but they have actually given guidance that their inventory is increased from 190 days to above 200 days, which is quite
Yeah,
significant. I know it's only 10 days, but the
yeah,
problem I have with a company like this holding so much inventory for so long is it becomes obsolete quite quickly.
yeah,
We're in a fast pace, fast moving technological world, and that's my problem with inventory being so high here. So that's not a trend I like to see, but I think that's
yeah,
something from Texas Instruments that has happened over the last 10 years. This guidance for how long they're holding the inventory has been increasing
yeah,
steadily over time.
yeah. Yeah, so if you then look at those numbers, right? Also now, if the long-term debt has increased because they need to borrow money at the moment in the last 12 months to pay the dividends. They have a negative free cash flow. Yeah, and I said, if you look at what they pay on a quarterly basis in dividends, it's like 1.1 billion. So this quarter, they lacked 1.1 billion for dividends. The good thing is they stopped the buybacks. Yeah, so they had like a few million of buybacks, so probably still like left over from somewhere, but compared to before, they just stopped it. But even over the last 12 months, they need to borrow money to pay out the dividends because the payout ratio on free cash flow is 140 at the moment, 143%. So that means they're lacking cash. Payout ratio of the EPS is 60%. And this is also what investors needs to know. If you look at EPS versus free cash flow, we always say free cash flow doesn't lie. Yeah, it's a more pure number because it's really the hard cash, and dividend is a cash outflow in the end, that because it hits our bank accounts. With EPS, you can do different stuff, right? And it depends on the amortization you use and all these kinds of things. Yeah. So what I'm trying to say with this is, yeah, net income numbers will probably also still look quite well for those reasons. But later on, for instance, it might be that the amortization depreciation kicks in after all those investments are done, and then you will see it may be reversed, that the free cash flow is really high, but the earnings are lower because they're writing off. Yeah, if they are not investing the same as what they're writing off. So these kinds
Yeah.
of things, I think beginner investors need to understand when you look at these numbers, and when companies are heavily investing, it makes also valuing a company much more difficult, as an example.
Yeah, no, I agree with you on that. Like valuing a company like that, particularly when we've already mentioned it's cyclical, but if the cash flow is varying,
Yeah,
depending on where you are in the cycle, that makes it hard for even someone like me that's not confident with my valuation skills,
yeah,
how you value that company. So we might get into that later when you talk about some of the discount models that you use.
yeah. Yeah, and then yeah, maybe the last thing, because I was touching here also on the quarterly earnings, right? So I think the earnings were not too bad, but if you look at pure sec at the demand decline, right? It was a tough number. They for instance, the revenue is 13% down year over year. Net income is 25% down year over year. These are really bad numbers, and then having now a negative free cash flow. So, but to your point, we come off a really high peak. We see this with a lot of these companies. But I think the numbers are not good, and maybe we should go slowly to the valuation here. So first of all, addressing that question, how do you value now a company that is heavily investing here? Now, the question is first that I think because we are not value investors, we're dividend growth investors. Yeah. So first of all, the question we need to ask is the dividend safe, and can they and will they grow the dividends? Yeah. Now, if we look at their dividend history, it paid out 9 cents in 2004. It paid in 2015 $1.4, 140. Then it paid 321 in 2009. Now 496. So the dividend has been growing really high at a CAGR of, so compounded annual growth rate of about 17% over the last 5 years and 21% over the last 10 years. Yeah. So the question, for instance, is this expected to be like this going forward? For me, not. If they are heavily investing, I can't expect it. However, it depends again on two other things. What does the dividend policy say? The dividend policy says a growing dividend. Company seems to be committed to that. Then the next question is like, okay, so hey, wait a second. Their net income is positive, easily covering the dividends, but they are cash trapped at the moment. So how does a balance sheet look like? Because you can if you have a really healthy company, if you're Microsoft, you can easily let your debt go a little bit up during these times to show the commitment back to your shareholders, because your shareholders are committed, they are in it for the dividends as well.
Yeah.
So then, is the dividend safe? Yeah, and such. And how does the balance sheet look like? Well, they have an A+ credit rating, which is just a top-notch credit rating. Maybe not AAA, but it's just really good. Debt to equity is 70. I like to see it around 60%, but their interest coverage is 22. So based on their operating profit, it covers 22 times the interest payment. So from that point of view, I just don't see an issue. If the company is it's showing it is verbal in that they want to pay a growing dividend, they speak a lot about that in their capital allocation. They are also having a really nice track record. So my expectation, my prediction here is, and they're investing now, by the way, in the future to get way, way more revenues later on in 4 years from now, let's say. And I don't see a reason why they would need to cut the dividend. Though I do believe we will see maybe some dividend growth hikes of 3%, 4%, 6%, something like that. Yeah. So I think that's the first question we need to ask ourselves. Do we see the dividend growing, and is the dividend safe? So my answer is the dividend is safe. It's not the safest dividend that we know of, not compared to Microsoft or something like that, but safe enough. And the whole industry has really strong growth prospects.
Yeah.
So then, if you then have these variable cash flows, you can do two things. You can go to your free cash flow, to the discounted cash flow template that I have, for instance, and you can just manually do a prediction of every year's free cash flow. The company is telling us what the capex will be. So you just only need to make an assumption on the operating cash flow. Yeah, that's the only thing you need to do there, and then adjust the numbers. But that sounds quite complicated still for Mojo, because it's a lot of guesswork. But if you think that the dividend is safe, you know what I would advise at this moment in time or recommend, and that's what I'm doing myself, just use the dividend discount model. Because dividend discount model is also a form of cash flow model. You just know that the dividends is a cash payment towards us. It's the main thing that we are rewarded in. So if you get the dividend paid, you take this 496. I would like to see a return of 10% in generally as a discount rate. And then in this case, I expect a 6% dividend growth rate on average, let's say, over the next 10 years. So maybe 3% now, 10% later when they are back on track, maybe even one time 15 or 20%. So if I use these numbers, right, and or a 7% growth rate even, let's say 7% growth rate on average, I get $165 as a share price. Yeah. So for me, this is something like, I know now it's a stable number, and I find the dividend discount model probably the easiest model for these kinds of situations. If you do like 6%, it will be like $144, $145 at a 10% discount rate for this company, because it's a high quality company. Then you know kind of in which range you need to look. Now, that's why I think this is just the best model, and I think we don't even need to go into the DCF here for Texas Instruments, because it will be really complicated to explain this also in a podcast format. But what is also still good to know, their return on invested capital is still like 14 or 13%. I just calculated manually right now, which is higher than their cost of capital. So they're still like a healthy business generating shareholder value. So that's how I look at the company right now and how I value the company. So let's say it's now trading at, 180 something. Yeah. So I've been always buying in the low 160s or something like that, high 150s, and I will stick to that number. Yeah, I have enough belief in this company. It is yielding at the moment 2.67%. It will then yield about 3%. it's for me a nice entry price while they are getting through this investment period.
Yeah, and if you want to simplify that a little bit further, that's probably, if you're looking at a fair value price of 165, that's roughly around 20 PE. I know they're trading around 24 at the
Yeah.
moment.
If you take the APS numbers,
Yeah,
exactly, 20
yes.
PE.
So it's roughly around 20 PE, which for me is fair for a company like Texas Instruments. But it's quite interesting, is it? Because we spoke about Texas Instruments on this show before as kind of a no-brainer stock that you should buy. But it's funny when you dig down into the financials, some companies can have problems, and it's important to be aware of the problems that lie. As you said, it's only been a quarter, and they are coming off a high base from last year, but it could be the start of a little cycle for them over the next 2 or 3 years. So
Negative free cash flow is always a red flag, and the same applies to Texas Instruments. That's why it doesn't have a very safe dividend rating in our scorecard, just as safe.
Yeah.
And it is also not too high above questionable. So maybe full disclosure, right? We use these ratings like 40 to 60 is questionable, 60 to 80 is safe, and 80 to 100 is very safe. 80 to 100 is where the Microsoft and the Apples are. For us, in our model, it scored a 66. Yes, so it's closer to questionable than to very safe. And one thing I've learned on this model, I trust it because it's a combination of free cash flow and net income growth. That's one element of the points that they score. Then it's the balance sheet, and it's about 60% debt to equity. So that's where it loses some points. 5-year free cash flow growth in the first bucket, it didn't do it. It lost free cash flow. So where it really scores the points is on the dividend metrics and on the growth prospects, which we take into account. Yeah. So, but otherwise, it's a 66 score out of 100, and that's it. So people, and I take that also into account. So it's not a company that I will now go full blown into when it's in the 150. No, there's elevated risk, and I know they are going 3-4 years to this stage. So this is for me like a little bit buying here, a little bit there, but I'm not going full into the stock at the first opportunity.
Exactly, yeah. And the fact that they had to borrow to pay dividends over the last 2 quarters, I'm not really enthused around that either. Particularly, I mean, we're not in a 0% interest rate anymore. We're in a higher interest rate, so they're paying a lot more money to pay us dividends. So look, I don't think it's an automatic buy. I don't think it's like your Johnson & Johnson's anymore. I think, as you said, they are risks, but it's still, I mean, historically, a good company in terms of their business, but also their numbers and their returns to shareholders. And
but for me, it's a top 10 stock. If I would retire, I wish it was in my top 10. Let's say it like that.
But what we haven't seen is the share price reflect these risks yet.
Share price is still, maybe tomorrow morning, but
after we release the podcast, maybe
exactly. There will come a transcript on Seeking Alpha, and suddenly, like, everyone is scared. We will be on CNBC.
But interesting. Look, it's a good business to look over. I'm curious to hear from our community what they think of Texas Instruments. Are they buying? Are they not? What have we left out? More importantly, if there's anything that we are missing, please let us know. But I love doing these business breakdowns because I always learn something new every time.
Yeah, me too. And I hope the listeners like it as well. We are doing this again because Realty Income last time was really enjoyed by the people. So I hope that they also enjoyed Texas Instruments. And let us also know what company you would like to give, like us, like at the end of August, to do a business breakdown on. Because if people like it, we aim to do this like once a month. Take a bit of a time, like half an hour, 40 minutes, really to go through the company and not just like quickly the numbers.
Perfect. So we might move on then to some listeners' questions. We have a couple there to do. The first one is from Centrino, and he's asking, with all the stock prices being up, how do you manage to keep buying every month? And what did you buy recently?
Yeah, so this is my deep philosophy that I developed over the last few years. It's not a stock market; it's a market of stocks. That means for me, there's always something at discount. It's like if you go to the local shop, sometimes it's Black Friday and you see everywhere a sales sign in the same shop. And during normal times, they have, I don't know, this time that product a bit in discount and then that product a bit in discount. That's how I look at the stock market. Yeah. So there are always a few companies that interest me. Of course, I've been buying insurance companies. I think I discussed already in last week's podcast some of the transactions that we did. But I must also say, after last week, when we were talking, I bought a little bit of Enagas just to top up the position because it's still space on it here. And that's actually what I bought so far. Let me check. Anything else maybe in July? I'm quickly checking my portfolio tracker because I see a lot of dividends here that came in. Yeah, so I bought Legal in General and Enagas this month so far, and I'm still looking a little bit at a low yielder, but high growth for this for the upcoming week.
Nice. I haven't bought anything yet this month. The last transaction was Enagas for me as well. But this month, I'm hoping next week or the week after to sit down and make my purchase for July. I know I'm pushing it into August, but
you shouldn't. You shouldn't. DCA, baby.
Well, I still have the same amount, so like my July amount is still there, so I'll still be spending that. It's not going to go to waste.
Good.
Casper has asked us about your thoughts on ticker symbol APAM. It's a Dutch company, and I think you mentioned it in one of your blog posts about Dutch companies as well.
Yeah, so it's called APAM, and I think they might also be listed in Luxembourg. Yeah, so it's one of those that I have an article on my blog, the 15 best Dutch dividend stocks, right? And it's one in there. And look, they are a global producer of stainless steel, electrical, and specialty steel, let's say. It's really a large company, but we don't really talk ever here about steel producers as such, right? But they operate in facilities in Brazil, Belgium, France, and they have 3 segments: so stainless and electrical steel, services and solutions, and alloys and specialties. So the question here is what my thoughts are about it. Look, I can't say too much about it from the fundamentals of the company itself, but I quickly looked the company up. They pay, I believe, a €2 dividend per share, which is at the moment around a 6% yield. And if the numbers are correct, they are now currently spotting like a 24% payout ratio, which is of course quite low. So it shows that the PE is really suppressed. So it's a relatively high yielder. The dividend growth has been there, right? That's why it's part of the best dividend stocks, because they do pay a growing dividend. It's not a flat, nice curve up. It's some flat lines in between there. But the main issue I have with APAM is like, if you zoom out of the stock and you look back at the last 10 years or so, yeah, it has been trading effectively between let's say 9 years, €25 and €40, and it's now trading again at €29. So it has been kind of dead money, and that's also always how I look at this business. It's kind of in the business of commodities, steel production, heavily influenced by governments. So that's my issue with liking a business of APAM. But if you look at it from the dividends so far, when I quickly looked at the metrics, it all looks fine. So it's more like know what you own. Yeah, there are investment cases for this, because if you get a 6% yield, you reinvest it, you let the snowball go, you can easily double via reinvestment maybe your share count over the next 10 years in APAM, and you might have a really great investment case.
Good. Nice one. Jacob has asked us what our thoughts on the tech sector in general is at the moment. The AI craze has made everything seem like a rocket off, and everything seems a little bit richly valued at the moment.
Well, the question is, with richly valued is always, of course, like, yeah, if you compare it to where the stock price was 2 months ago, yeah, they shot up. The question is that the future prospects, on profits also grow with the recent boom of AI. Now, look, I work in the tech sector, and my thinking is this: there's no doubt that ChatGPT made a large impact in the tech sector. I have a lot of people that I know in IT that are using ChatGPT almost on a daily basis now. Even I introduced it to my wife this week. She had to create some documents for something that she was doing, like some dummy documents, but she needed text, and she was like, "Oh, no, I need to copy text." And I said, "Just ask ChatGPT to generate it for you." And instead of an hour work, she saved it, and she did it in 5 minutes. That's the power of ChatGPT and large language models. So there's such a productivity improvement that I can see here that this will be a boon for years to come, because this is going now by Microsoft being embedded into the way we do office work. Yeah, remember how you were writing emails to a colleague, and it needed to be formal, or to a client. I just I just put in ChatGPT, write a formal but empathic email to a client with a nice introduction about this topic and this and this. And then poof, you have it and you do it. In the past, I was like thinking about the email, this and this and this. It would take me half an hour, and if it was really a formal email where I really had to pay attention to things. Now it's like 10 minutes, because ChatGPT does it in 5 minutes, and then spend 5 minutes giving my flavor to it as what my personality is. This is what, and this is just an email, but think about writing documents. Write an intro, or write a summary, the executive summary for this document. Only thing you need to do is a little bit of editing. So for me, what we're seeing here is real. That's the first thing. I just think that now it's being hyped again, and we saw this also like during COVID with the wet signature companies that existed for years. Suddenly the world would change, and they were valued like 10 times higher, like DocuSign. No, it's still a bloody wet signature company like it was before, and then all of this. So I didn't believe in those bull cases. I have the same with these, but I think the real winners like now will be Microsoft, because they have a. We need to think about AI and productivity, and what companies can generate productivity almost within a year for us. Microsoft can do that with the Office suite. Google can do that. Yeah, then you should think like, does that require more power? And then you can talk about AI algorithms. Yeah, NVIDIA and such, right? Now the question then is, are they too high value right now? You will need to do that per company individually. Yeah, but the boom that we are seeing, I think a lot of it is real, and it reminds me, or it makes me think about the internet bubble that we saw. Yeah, it can go too high, but think about how internet has changed the way we live. Yeah. And this is the same how I think about AI, and this ChatGPT blew me away. It was like, okay, now I finally see that it's real. Was the first awakening that I felt it, having worked now 15 years, 18 years in IT.
I mean, ChatGPT is the tip of the iceberg. It's what's available to us as the public. But what's going on behind closed doors in the industry is a lot more powerful. There's a lot more there. I've been lucky enough to be involved in some pilot scheme in my own work. And it's blown me away what is available, and it's industry specific as well.
Yeah.
So the things that we can do automatically now it's a pilot, but it is going to be a game changer. And absolutely,
5 years ago, this was not possible. 5 years ago, we were talking about data mapping and rule bases where we're just coding every rule. Yeah. And people need to know that was manual. Many developers you needed for that. And this is really the game changer right here with this breakthrough. And it is because of computing power, the evolvement. This is what you often see, right, with these kinds of new technologies. This is maybe initial hype cycle or something like that 5-6 years ago, but then it takes some time. It takes investments before it comes to fruition. But then when it comes there, it almost like pops. Yeah, and that's what I feel now working in the industry. But definitely, I think it's shooting too far up in the media. If CNBC is with everything talking about AI, and every CEO talking about AI, you see it in every earnings report coming back, you know that this is bubble territory here.
Yeah. Okay. Good question. Took more time than I thought on that one. Dave S has asked us, what is your best bet in electrification and automation? I think that's going to be Siemens, hands down Siemens. I think they are the biggest competitor in that. I spoke about ABB last week as well, but Siemens for me has the scale and size to be a big player in both, and they are a big player in both. So that's where I would lay my bets. Next gate, could you add a section on your podcast about a few dividend stocks that, in your opinion, are priced deliciously at the moment of recording?
Yeah, I have a bit of moral issues with that, because we started this podcast to more like we want to empower people in Europe, especially, but also in America, to take matters in their own hands. So we rather teach people how to fish, and we do that by explaining our thought process. We had in the past a stock tip. Yeah, we can do that maybe from time to time again, but stock tip was not always about deliciously priced. Yeah, it was more like about maybe what we are buying at the moment, and for what reason. But I have moral issues with putting this, because then we become like the Jim Cramer of the European podcast scene, and
Yeah,
I don't think that's what we are there for. We rather answer questions that are about how do you do this, how do you do that, and then we can share our experience, and then people can look themselves for what is deliciously priced.
yeah. I think the hints are in what we say we are buying. I would never tell anyone what to buy, but we spoke
Yeah,
about insurance stocks, we spoke about utility, energy, gas, and so on. So for me, I would not be able to answer you and tell you what is deliciously priced for you, because your fair value
yeah,
might be different to mine. But as I said, over the last few shows, I've talked about buying Vici, insurance
yeah.
stocks, and also energy gas. So that's what I am buying.
And we always say also to your next gate, you can't borrow conviction. Yeah. So what do you do with the information? If you then start buying with that, remember, if then suddenly the stock doesn't go up or it crashes, you are likely to sell it very quickly, because you don't know why you own it. You own it because two guys that you have never seen on a podcast have said to you that these are deliciously priced. Yeah.
But like Unilever back in the day, when we were talking about Unilever a lot, that didn't move for 3 years now. It's been,
Yeah, exactly. It's been dead money. Yeah.
in fact, it's been dead money. So yes,
Yeah.
don't always take what we're buying as gospel either.
Yeah.
Investimator has asked me a question. Did your fair value of Microsoft around 180 change after you failed to buy it on its way down last year? What would you say was incorrect in your fair value estimate calculation versus the market? I think my 180 estimation, that must be 2 or 3 years at the time now, and I got fixated on that, and then we had the run up and came back down. What was different or what was wrong, I would say, is just the amount of cash, the amount that they moved on in those 2 or 3 years. They just accelerated, and I never just kept accounting for that. For me, I was just price anchored at 180, but I kind of regret that now, because they are sitting at over 300. So I was wrong. But like I said, look, valuation is not my strongest point. I try and simplify it. I've came away from discounted cash flows, because for this reason I was getting bogged down on it. So now I used to use simple metrics and worry about future cash flow, future pricing, and then that is easier for me to buy and not get price anchored on. Casper has asked, hey, do you know if Kenvue can be sued for Johnson & Johnson baby powder litigation?
I honestly don't know. It's a really, really nice question, because I've never thought about it. So it's something what I need to figure out, because you would expect so, right? It's the consumer health business. It's in there. So I would assume that the litigation gets carried with Kenvue. Yeah, but I assume that this is not like, they wanted to file this. What was this into the bankruptcy company? I hope that Kenvue isn't like a hidden name for bankruptcy filing.
No, I wouldn't think so. I would have your stance on it. I would imagine they can, but I would say there's something baked into this split off, where Johnson Johnson might take over the bulk of the responsibility there. I don't know. I'm guessing, but hey, look, anything is possible in America.
Yeah, and let us know if someone knows, right? In the Facebook group, just send a message, and Casper will be happy as well.
Yeah. Anders then asked us maybe a comparison on Texas Instruments against some of the chip space, so Qualcomm, Skyworks Solutions, and Broadcom. Do you think Texas Instruments has a moat against their competitors? For me, yes. Even when it comes down to brand power alone, before dividend investing, back in my college days, or even work before that, I never ever heard of Broadcom, Skyworks Solutions, or Qualcomm. Just never heard of them. But I 100% heard of Texas Instruments. They're the number one in that space. For that alone, I think they do have a moat over their competitors.
Yeah, and some of these companies are also operating different space. For instance, Qualcomm is really on 5G. Yeah, really powering almost every mobile phone. Qualcomm. I believe even Apple at the moment is using some Qualcomm stuff still. So, Texas Instruments isn't heavy in such stuff, right? I believe they are not providing chips, 5G chips for mobile phones to Apple and such. So these are businesses that are, again, kind of in their niche within the semiconductor space.
Yeah. Cool. Nice show. Thanks a million for all our questions. And again, thanks to you, European DJ, for jumping on with me on a Tuesday night. And I hope you enjoy your weekend.
Thank you, Derek. And hey, everybody, see you next week.
See you on the outside. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to my podcast, you agree to hold ourselves from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.